to about. As we go through, then these help screens come up as you go from page to page. And just again, the See Also button will give you step-by-step instructions. So these help screens that come up are really designed for people when they're first starting to use the software, so that as they go through things, you know, that the help screen is immediately available. You can turn these help screens off by clicking Help in the menu bar, Show Help, and you can see how all of these checkboxes are selected. But if I click Show None, then now when I go to the different pages, I've turned off those help screens. So the first type of help is that page help. That help screen is the same as the help button in the lower right corner. So I want you again to be aware of it so that you don't necessarily have to go to help and show help for the help topics that are on the various pages. You can just click that help screen in the lower right corner, and then it'll again give you the overview with the See Also step-by-step instructions. The next type of help that I want to touch on very briefly is how-to help. So every single panel in the software has a help button in the lower left corner, and that help button is context sensitive. And again, when you click on it, you'll get overview help. And then if you click See Also, that's when you'll get step-by-step help in how to, you know, complete the particular panel that you're dealing with. And this is the help that I find people neglect to use. And I won't claim that, you know, like any help, that it's perfectly clear, because of course, you know, I read help all the time in other software, and half the time I'm confused. But I encourage you to remember about that help button, because very often we get questions which could have been easily answered if you click the help button and then the See Also button. So it's just a waste of your time and leads to some frustration if you're trying to do something and you can't figure out how. But if you click the help button, it might give you exactly the information that you need. The other thing that I'll just remind you about is that in these help topics, anything that's in green is a jump topic. And the jump topics are terms, rules, and regulations, that sort of thing. So if I click JTWROS, for example, then I get a definition of the term and what that means, or EAT, Estate Administration Taxes, what that means. So let's just keep that in mind as well. And then if I go to help and show help, there's also then terms, rules, and regulations. And notice I'm double clicking on each of these to open them up. So then I can go to any particular topic and, you know, click on it. And again, I'm back to joint tenants with right of survivorship and what that means. So the jump topics, the terms, rules, and regulations are built into the step-by-step instructions. But quite separately, you can also go to help topics, rules and regs, double clicking to open it up, and then, you know, look at a particular term, for example. The other thing that I want to just talk about with help is what's this help and where do I find? And these two are really important in a graphically driven program like VisionWorks. So if I'm looking this house, townhouse, condo, rented, what's rented mean? Is that a rental property or a place that I rent? You know, what's that intended use? So if I'm looking at something and I'm wondering what it is, I can click help, what's this? And you'll notice that the help pointer becomes then a help pointer with a little question mark. And then if I click on rented, I get an explanation. So it's a rented home, you know, an apartment, condo, townhouse, whatever it might be. And then also notice it says to model a rental property, go to financials or details and the other tab and rental property button. So if I'm looking for a rental property then I'm instructed to go to other and then rental property. The flip side of what's this thing that I'm looking at then is where will I go and find something? So if you open up help again and go to the where do I find index, and once again double click on everything, then that's when you can click, for example, the letter R and look up where would I go and find a rental property. And then if I scroll down, it says, you know, other rental property. So we can see now that we're on other and there's rental property. So again, in graphically driven software, the question is, what am I looking at? What's its intended use? Do I have it? Am I looking at the right thing? Or alternatively, where would I go and find the thing that I want to use? Everybody okay with help topics? Is there anything that you'd like to ask?
No, very good.
Okay. So the next thing we want to do is we want to look at the three types of entries. And I define these as being static. So the buy-sell entry for a house is a classic example. And what I mean by static is that there are fields into which you enter a date or an amount, for example, might be a percentage. And these are fixed things. In other words, you can only have one purchase date when you bought a house or will buy a house. It can only have one amount that you paid for it at the time you bought it, and it can only have one current value. So static entries are appropriate for things like dates or amounts or percents or something like that. The second type of entry is what I refer to as ongoing. And ongoing just means it continues over time. If it's red, it means that it's an expense. If it's green, it means that it's income. And normally they're dollar values, but you can see for an appreciation rate, it's also ongoing, except it's not dollar values, it's a percent values. So that's an ongoing entry. And then the third type is what I refer to as a discrete entry. And a discrete entry is something that happens at a point in time. So it's represented by a vertical bar. And then, of course, we can move this to sometime in the future. We could move it up or down in value and so on. So the three types of entries that you're going to see over and over and over again are static entries, fill in the panels, ongoing entries, you know, manipulate things over time, and then discrete entries, vertical bars, something that happens at a point in time. And when it comes to a lot of what you're going to be dealing with, a great many of the things that really change as far as the input panels are concerned are actually these static type entries. So if we go to an RSP limited in terms, you can see if we go to the RSP limit tab, static entries. You know, what's your unused RSP deduction limit? What's your earned income from last year? What are any undeducted contributions that you've made in the past? Fill in the blanks. So again, when you click help and then see also, the step-by-step instructions will tell you exactly how to complete the different fields. And these are the ones that really vary, if you will. So if I use as an example, other assets and employee share purchase plans, you can see that when I go to details, it's just a whole lot of different fields that need to be completed. And again, to understand what to do, clicking help and see also, and then just following the instructions field by field, you know, is going to help you, you know, model everything correctly. So it's the static panels that really represent the things that are different about different assets, rental properties, you know, employee share purchase plans, things like that. Again, if I use a rental property as an example, and we go to the buy sell panel, this is pretty straightforward. When did you buy it? What did you pay for it? But if we go to building land details, you know, what was the split in the cost between building and land, what are the current values of the UCC, the value of the building, the value of the land. Again, these are all panels that we're filling in. So that's the static side of things. And what I want to do now is I want to go back and I want to have a look at the ongoing type entries so that we can learn more about how they work. And actually, I think what we'll do is we'll use a lifestyle expense, and we'll go to vacations and winter vacations as, our first example. So this is something that I speak about very often. Even if we're doing retirement plans, it's my view that we should have general expenses, the kind of expenses we're always going to have, groceries, clothes, whatever it might be. But even if we want to simplify the retirement plan, we talk about breaking out home expenses and associating them with homes. It makes planning a lot more accurate and easier if people at some point end up downsizing their home because the home expenses will change. I talk about, as you all know, itemizing vehicle and vehicle expenses. People could very easily be a 2-vehicle family today and at some point cut back to 1 vehicle and then at some point quit driving. So we don't want to assume that they're going to have expenses for 2 vehicles through the course of their life. And then I always talk about vacations, and I talk about vacations because they're a classic example of how things change over time. So the idea with an ongoing entry, or most ongoing entries, in fact, is that they will change over time. So let's learn how to manipulate the winter vacation entry. So we've got this sort of default value, $5,000 continuing forever with the inflated value. Let's open the table. And then if we want to change something, then as you know, all we need to do is left click on the graph to enter a change point. 2026 is their first full year of retirement. And then we can drag that dollar bill bundle up, or what we can do is we can type in the table. So if I want to say, my $5,000 expense is going to increase to $10,000 once I'm retired, I have more time, then we can either drag the dollar bill bundle or type a number in the table. Generally speaking, what I'm going to suggest is that if the values you see on the graph are relatively close to the default values, the default here being 5,000, then it's easy enough to drag. If it's not, in the same proximity, then it's much easier, of course, to open the table and type a number in the table. Now, again, in this case, we're not going to be spending that money when we're 85 or 90, so we can, drag that back to some age, let's say 80 and 75. And then if we wish, we could even click and enter another point and stretch it out another 5 years. And again, you can either drag the number around or you can type it in the table. And the other thing that I just want you to be clear about, because this is a fairly new feature, is that you can actually open up the year list and you can change the final year by selecting it in the year list. So if I change 2043, you can see that final year now adjust back to 2043. Or if I wanted to start this later because of COVID, then I could go in and make the start year, let's say 2023. So manipulating things over time, creating change points on the graph, you dragging if the numbers are in close proximity, or otherwise entering numbers in tables. And then if you want to delete entries, it's just a matter of doing a right click to delete an entry. One of the other things that you'll see, by the way, let's just go back and look at this, is that if we change the first point, what happens is the endpoint does not automatically change. So keep in mind that all these percent symbols or dollar symbols or percent symbols are all independent, and they need to be independent so we can go in and change things over time virtually any way we want to. If a subsequent point changed when we changed the current point, then we'd have things flipping all over the place, because if I went and changed this, this might change and so on. So they're all quite independent. So if you've got a straight line that only has 2 points on it, you change the first point, you have to change the next point, which is the last point as well. So just keep that in mind. So let's go back and look at a career entry. The type of entry that I've been showing you with the vacation that goes along, and then at retirement, that's a very distinct change point in life. Pre-retirement, limited time; post-retirement, more time, spend more on vacations. That type of graph is what we call a step graph. Things go along and then suddenly step up. But what we should also be able to do is work with what we call gradual graph. So I'm going to just create this self-employed professional income. And let's assume that we're dealing with a young doctor. Of course, Bill's 60, so just imagine that Bill's 35. So I'm going to stretch that out in time. And what the young doctor tells us is that he's making $150,000 now, but in 5 years' time, he expects to make $500,000. So we can go in, select that year. Now, this is a case where dragging would be, very slow. So I'm going to use the table because it's a large incremental change. So now I can put in the $500,000. Note the end dollar bill bundle didn't change, so I need to drag it up as well. But I have, again, this step graph where things went along and suddenly stepped up. And then you can recognize the step graph, not only because of the sudden change, but also the inflated line goes up in steps. Well, this is the case where I don't want it to step up. What I want to do is reflect the fact that the doctor is going to be making progressively more year after year. So all I have to do is click the graph type button, and I switch from a step graph to a gradual graph. And I'm not imagining that, sorry, that should be down to 500. I'm not imagining that this is necessarily exactly accurate, that they'll go up in these precise increments every year. But what I do want to do is I want to reflect the idea that his income will be gradually increasing over time. And I could go in and add intervening change points if I wanted to reflect maybe slower increases in the first few years and larger ones later on. But the idea is really to be able to say, I'm making this today, I'm going to make much more in 5 years, to reflect that change in the real income. So keep in mind step and gradual graphs. Let's go back now to our homes. And I want to look at some of the other features. In particular, I want to look at the paid by table and the index by table. I was doing a demo recently, so I can see that I've made some changes to the payer. You can see it's Bill and Sue, and then it becomes 100% Bill, and then it's back to Bill and Sue. So you can click on a year, change the payers in that year, and then that will insert a little P flag, a little change of payer flag. And what I was illustrating was that Bill and Sue may be sharing their expenses jointly right now, but in 2022, it could be that Sue takes time off, she's younger, they're having children, she wants to stay at home with the children or a child until that child, let's say, is in daycare, or sorry, in junior kindergarten. So she's going to be out of the workforce. Bill's going to be picking up all of the expenses. And then a few years down the road, child's in junior kindergarten. And so, she comes back into the workforce and then is a payer again. So just keep in mind that payers can change over time. And similarly, if we go to the buy-sell panel, even though the ownership of an asset might be 50-50 joint ownership, that doesn't mean that people have to pay for 50-50. And similarly, if we had a financing entry like a mortgage, let's just throw one in, then when we look at the mortgage, just because the ownership is 50-50 doesn't mean that the payers need to be 50-50. We can go to show detail, change the payer, and we could, for example, make Bill or Sue the 100% payer of the mortgage. That's not in the least uncommon. So somebody in some families will pay the mortgage, and somebody else will pay the grocery bills, and they can split up divvy up how they pay expenses any way they want. So you have the ability to change payers and also do that over time. I want to talk about the indexation factor. So everything defaults to real zero, and real zero means no real increase, merely increasing at the inflation rate. And if we go back to settings, you'll remember that there are two inflation assumptions that you can enter. One is the government rate, which is used to index the tax brackets, OAS, CPP, and so on and so on. And then there's the general inflation rate, which applies to things like groceries or whatever. We default to the FP Canada rate, but if you look at the government rate over the last few years, for example, and the rate that's used for the indexation of tax brackets, it's around, I'm going to just say, roughly 1.2%. But if you look at the price of milk, you might decide that the cost of milk is going up at a much faster rate than that. So you have the ability to distinguish between the government controlled rates and your experience of prices at the grocery store. So let's go back to property taxes. I think this is a classic example. So we default to real zero. So this is 2%. So you can see 5,000 becomes 5,100, 5,202, and so on. If I entered real 2, that would mean my inflation assumption plus 2%. So my inflation assumption of 2 plus 2 is 4. So I'm getting 5,200. If I go to nominal, that means inflated at whatever I enter in that field. So nominal 0 would say no inflation. So you can see that the today's and inflated lines are the same. But I could enter something like nominal 5, and I've selected property taxes specifically for this reason, because anybody that lives in Toronto, and I don't know what it's like in other major centers in Canada, but anybody that lives in Toronto, their experience of the rate at which property taxes increase is that it's much higher than the stated government inflation rate, like much higher. So one of our basic principles is the ability to portray the client's circumstances, financial circumstances, a disabled child, RDSP. If you can't put that RDSP in the plan and somebody has a disabled child and they have an RDSP, they'll look at the plan as being incomplete and inaccurate. So I refer to that as completeness, the ability to enter what it is that reflects the client's circumstances, but also the ability to enter how they see things unfolding or changing over time. So that's the spend more on vacations once we retire, but we're not still spending, lots more late in life. And related to that then is this whole indexation rate. So if a client set is particularly conscious of the increase in property taxes being much greater than the inflation assumption and says something about, I want to see the property tax increase at 5% per year, for instance, then you can accommodate that. You can make it nominal 5. Or you could make it a percent of inflation, 150% of inflation, something like that. So you can change that indexation any way you wish. And you can also change it, just like payers, you can also change it over time. So again, if we go back to our career entry that we created for Bill in his self-employed income, you may have a client who says, let's just bring this back down to 150, but you might have a client who says, I expect growth in my business of 10% per year. Well, if you go in and enter nominal 10, what ends up happening in not too many years is that the client owns the world. 150,000 is now over $1 million in roughly 20 years time, compounded at 10% per year. So that becomes a little unrealistic. So maybe it's 10% growth, for the next 5 years, and then after that, maybe it's 5% growth. So you can change the indexation rate over time. And when you do make a change, you get a little I flag that shows on the graph reflecting that there's been a change in the indexation rate. By the way, to get rid of the I flags or the P flags, change of payer, you need to make the change year the same as the preceding year. So those are the three basic types of entries, what I call static, fill in the blanks, and again, make sure you click help and see also because it tells you what to do for each field. Ongoing entries that continue over time, and they're the ones where you can change the payer or change the indexation rate, for example. And then the discrete entries, which are vertical bar graphs. And the most common for those are vehicle entries. So I just want to touch on them very quickly. So I'll just add a car purchase. And what we want to do for the current value is we want to put in the value of whatever vehicle they own now. It's irrelevant what that vehicle is. It could be an old clunker worth $3,000 and they're buying, expensive new SUVs. But the purpose of the current value is simply because it will be depreciated until the next purchase and then traded in against the inflated value of the next purchase. So we've got a vehicle worth $3,000. We want to buy an SUV this year for $50,000. And I'll just open the table. And what we want to do is we want to replace that SUV every 5 years, let's say for the next 50 years. So now we have all those SUV purchases. So the $3,000 will be traded in, depreciated. We're buying it the same year, so no depreciation, traded in against the value of the next purchase, which will then be depreciated, traded in against the inflated value of the next purchase, depreciated, traded in, and so on and so on. And then in this case, I've got more than I really need, so I just right click and delete them. And then also you can finance those entries. So I could go in and finance all of them. And when I do finance them, what will happen is that the software will finance the difference. If I've selected reduce loan by trade-in value, it will finance the difference between the trade-in value and the inflated value of the next purchase. So, that's the main factor. And also, just so you're aware, I refer to this as dynamic debt. So if I get rid of some of those future purchases and I change how much I spend for the vacation and go back to the terms panel, you'll see that the debt financing has automatically adjusted because of the adjustments that I made to the purchase. So again, the concept is working interactively with clients or collaboratively. So anything that is logically would change if I change car purchases, change amounts or whatever, change the years, then the related financing is automatically going to change in the background. So I don't have to go to the terms entry and start making those changes in front of the client. I just need to update what they've got in mind for their vehicles. And the same thing happens, of course, if we go in and say we're going to sell the property right now. we have the related home expenses out to the life expectancy of the longer lived of the couple. And then we can go in and say, well, we're going to downsize this house, sell it the middle of the year in, let's say, 2030. And then what ends up happening then is any related expenses will automatically end that year. And this will show, by the way, the full year amount, but in the background, it will be prorated for the month of the year when we sell the house. So it would be prorated for the first 6 months of the year. So I think those are the main things that I wanted to cover. Just a couple of other little things. If we go to help, if we go to options, you can change the size of VisionWorks display on your computer using the size feature. The color scheme allows you to change the colors. So you can change the colors of the navigation bar to be your corporate colors for branding purposes. And then the default choices here are kind of the main colors that can be complementary with the colors that you set. Also, I just want to touch on the right-click menu because I think it's extremely important. I was having a conversation with a client earlier today, and he was talking about a recent experience where the couple were speaking about renovating the kitchen, and the wife said, you know, she wanted to spend $100,000, and the husband said 50 was his limit. So one of, I think, the great pitfalls of planning, the way it's done, where we create a plan for the client, is that in order to do that, we need 2 points. We need the starting point. What are your assets? What have you got? And you know, what's your expected income and so on. And then we need the end point. What are your goals? And the underlying assumption when we're working with couples is that they agree on all of their goals, which we know, of course, is not in the least true. So what ends up happening often in the financial planning exercise is that advisors try and reconcile different points of view. Why do you feel that it should be 100? Why do you feel it should be 50? And that never works. So we instead talk about reconciling different points of, acknowledging different points of view. So we can put in one point of view, let's just say it's the $20,000, and then we can add a second kitchen renovation. Don't forget, you can actually make a kitchen, and you could have many renovations, bathroom, basement, whatever. And then we could change that, and let's say we'll make that $50,000. And then the only way really to bring any rationality to the decision is to look at the output within the context of the whole, where we would right-click and exclude one entry and see the impact of the $50,000 on the output. And then we would right-click, exclude that entry, and right-click and include the other entry and see what the impact was. We could even do 2 solutions, including one in one solution, including the other in the other solution. And then, of course, on the Solutions tab, go to the Compare tab and see what the long-term impact is. So I want you to keep in mind that include, exclude feature. And then I also want you to keep in mind other things such as the ability to move an entry. If we put it here on the Joint tab and really it should have been on Bills tab, we can just click Move To, and then that entry is now moved over to Bills tab. That's the Own a Car that we put in. And then also if we create an entry and change it, and we've got it in multiple solutions, then we're able to do a right click and copy whatever change we make to any of the other solutions, so that we don't have to go and, you know, rekey everything in another solution. So just keep in mind this right click menu. It's really powerful. The ability to exclude entries, move entries, copy information over, and so on. So let me throw things open now to any questions anyone may have. So if you do have a question, you know, please just speak up.